Once again, welcome to everyone to our 7th lesson in the Market Profile Beyond the Basics course. Let's review the disclaimer together. Trading and investing involve high levels of risk. Future results can be dramatically different from the opinions expressed in this course. Past performance does not guarantee future performance. The presenter may or may not hold positions in the financial instruments discussed. Lesson 7 today is on initial balance trading strategies. The initial balance, as you will observe in the lesson today, is one of the most important parameters for the day session and has a strong influence on price reaction, as you will see, not only during the actual day when it occurs, when the initial balance is formed, but the relationships and the reference points continue to be relevant and important at later times, at other and different trading periods, and we will look at and examine those elements together in our lesson today. We will, however, begin by taking a look at our exercise and answering the questions. And before you here, we have a 1440-minute chart. The chart is a footprint chart, and it also has several filters on it. It's got moving averages, and it's got footprint statistics, bar statistics at the bottom of the chart. Now let's take a look at the question that we would like to answer. And the question is, what is the change in volume between the first and second 1440 bars shown on the chart? What would account for this difference? So we are looking at this bar right here and the bar that follows it, and we want to look and see, is there any change in the volume between the two? Well, one of them, the first bar that is at 1,586,664 contracts. The one that follows it is 1,458,157. The key question then becomes, what would account for this difference? Obviously, there is a difference. There's a difference of some 150,000 or so between the two, and in a 24-hour period, that really is not a terribly significant difference, but it is a difference. And what would account for it is really the interest of the participants in the market. The interest was not as active or as anxious and eager to get into the market on the prior day as it was during this particular day. So obviously, when we were selling, there was more activity. As the market was moving back up, it didn't attract quite as much activity as the selling had done. Now, based on the delta max, min, and finish data for the second bar on the chart, would you expect the new session to be bullish or bearish? So we see the beginnings of a new session here, or a new day, if you will. And we want to know, based on the data from the day that was completed prior to this activity, if in fact we can get a bullish or a bearish bias. So let's take a look at the max, the min, and the finish. And let's identify them here on our bar statistics. Here's my max delta, and right below it I have my min delta, and I also have my finish. Well, I have a negative finish, so by virtue of the fact that I have a negative finish, that immediately tells me that it was the buyers that were really more dominant towards the end, or just before the close. And they encountered a little bit of selling, ever so little, minus 672, relative to a max delta of 39,653. So this is a very bullish close. Look at how we closed one tick below the high and one tick below the value area high. That is the usefulness of the max, min, and the delta finish. It helps us to get an idea about sentiment and market bias once a session is complete. The expectation would be that we should see prices continue to rise in the following session. All right, let's continue on here. Is there any significant volume imbalance that's visible on the third bar on the chart? All right, so here let's take a look at what we have, and do we see any significant volume imbalance? The only volume imbalance we really see is here, a little bit to the upside and a little bit down here to the negative side. And it's not really significant volume imbalance. If you take a look at the numbers, they're not 3-4 times. It's just maybe 40% above or 20% above. There's no significant imbalances on that bar. The VPOC for all three bars on the chart appear to be close in price. What is the significance of that? That's an important observation. And take a look here. For the very first bar on the chart, here's the VPOC, the volume point of control. And as a reminder, the volume point of control is that price level where we have experienced the greatest trading volume during the entire session, in this case, during the entire 24-hour period. And when we look at them, and they're in very close proximity here again, we opened up here, and what does that tell us? Well, it tells us that this level that we're looking at, this price level, or this price range, if you will, in this area, is a very important and a very critical level. It was a level of resistance here, and it dropped prices. And then we've come back to it, and we've closed slightly above it. What remains to be seen is, has this zone become now a zone of support that will propel prices higher, or will it become a zone of resistance and it will push prices lower again as it had done in the past? And based on the bullish sentiment that we see in this day that just closed, the expectation would be we're probably going to push higher. Was there a significant difference between the AVAP for the first and second bars on the chart? Well, let's take a look. AVAP, that is the average volume at price, 16,569 for this bar, and we had 15,404 for this bar. Now that's kind of interesting. The average volume at price actually increased here, even though we had less volume. So that meant at each price level, or at each price, there was certainly more activity, more volume traded than the prior day. Also, this could be accounted for by virtue of the fact that the range for this up day was a smaller range than the prior down day. Okay, now we move to a different chart, a different problem on our exercise. Here in this problem, we are now looking at the open again in terms of two candles, the first 30-minute periods, and this will be a good introduction to our lesson today. We're still looking at the open, but looking at it in a number of different ways. In this case, we have the first 30-minute period that took place, which is this one right here, and it penetrated the value area high for the evening session. If you see, it went right through it, went higher, and closed just below it. So obviously it met significant resistance up here. You could see by this huge wick that sellers were up here, and actually prices were rejected when we tried to move above the value area high. Now, in the second 30-minute period, prices drop, and they drop all the way back down to the value area low and close just below it. Where do you think prices are likely to go or to move from this point, and explain your answer? Well, would you expect prices to continue dropping, or would you expect them to come back up for another retest of this value area? Well, based on the information that we have before us, there are a couple of other interesting things that we should note. First of all, notice the strong uptrend. And how do we know that? Look at my 20 above my 50 and look at the gap between the two of them. They are almost parallel to one another. That is a very bullish signal, or a very bullish pattern. Now, if that's the case, I would expect actually prices not to drop, but to go back up for a second test. After all, if my momentum and my trend is to the upside, this could just be a simple retrace, and let's go back up for a retest. That's why I would want to be long, and I would take a long entry at this point. Although the candlestick pattern that we see is a very negative one, but more importantly, if you take a look at the overall picture of what's going on in the chart, there is a very good possibility we are probably going to move back higher for another retest of the value area high at minimum, and possibly even to try to see how much further we can penetrate into this area up here. Would you consider this to be a bullish or bearish open? Well, it definitely is a bearish open, but just because we have a bearish open does not mean we're going to have a bearish day, because of the momentum as I described and because of the overall parameters that are going on in the market when that occurs. Well, take a look at what happened. What happened is prices actually did as I had anticipated and went higher for another retest. This is an important thing to learn when you're trading. Rarely does the market really break down and sort of continue on in one direction based on just a single test. So I would anticipate the market to come back up, take another look at this value area high, and now when I begin to see that we did not even reach the prior high, but we took a turn back downwards, and once I begin to take out the low of this green candle, this would be a good short entry. And if you notice, there was a strong short move after that. So initially the market pushed higher, but then it came back around and prices dropped significantly. Okay, does this appear to be a bullish or bearish open, and why? In this case, here's the evening session, and you can see the profile for it. And we have our usual simple 5, we have the simple 20, and we have the simple 50. Does this appear to be a bullish or bearish open? Well, let's take a look and see. We dropped down here, but we've obviously found buyers that pushed us back up to close above the volume point of control, but below the value area high. The next candle, what happens is we penetrate and head higher, but we really drop to close back within value. This is actually a rather bearish open, more so than it is a bullish open, because if it were a bullish open, I would have expected the buyers that pushed prices up so high and created this wick down here to have taken things even further and pushed higher, but they did not. Instead, we end up with a doji here, which is indecision or lack of clarity, if you will, and we're not quite sure what's going to happen at this juncture, but certainly we don't have a strong bullish presence in the market to propel the market higher and so on. It may come later, and sometimes it does, and in fact it may be a bearish signal that, that the move that occurred here during the first 30 minutes just is not sustainable, and therefore prices will continue to drop. So let's take a look at what actually happens. Sure enough, prices did not even make it higher than this high up here, and we started to see them drop. Then notice another attempt, another retest of the value area high, and the test fails, and as it fails, this would be an incredibly good entry to the downside. So you would short at that point. All right, well, we've covered our exercise, and now we would like to get into a little bit of the things that we really want to talk about, which is the initial balance. By definition, just as a reminder, the initial balance is the first 60 minutes of trading activity for each day, or in other words, it's your first two 30-minute periods. All right, so now that we've defined the initial balance, we can take a look together at some profiles with some initial balances on them. Well, on this chart, we have a bunch of different profiles, and as you can see, we have a wide variety and an assortment of initial balances. Now, in addition to the initial balances on this chart, we have a whole bunch of other lines. Of course, you recognize the value area low, value area high. You also notice the volume points of control. You also notice the value area low and value area high that are based on here's the other one here, that are based on volume versus the ones that are actually based on time activity. So we really have a hodgepodge of different reference lines. And I don't want to belittle any of them. I just want to focus us on certain key levels because we will use them for our trading strategy. And those key levels that we want to focus on are really the initial balance lines. And so what we've done here is on this chart is we have deselected, or if you will, we have turned off all lines except for the initial balance lines. And so now we have a variety of different initial balance lines on the chart. And I want to highlight for you, first of all, the dark blue ones, the low initial balance and the high initial balance. And then, in addition to that, if you notice, each trading session, in this case, we're looking at the 10-20 profile, or the evening and the day sessions. If you notice, there's also 150% of the initial balance, meaning if we took half of this initial balance, added it above here, to whereby the move would be from here all the way to up here would be 150%. Here's the 100, here's another 50%, so 150%. And here is 200%. So this area up here is equal to this area down here. That is twice. Now that's to the upside. If you notice, I have similar reference lines below. So here's my 150% line below the initial balance, and here's my 200%. And all of these are very significant levels, and I will show you that the market responds to them, the market respects them, and they are not really to be taken lightly. Another thing I want to quickly highlight for you is that the day session reference lines for the initial balance are far more critical and usually more respected in the market than the evening sessions. Usually the evening session initial balance, that first hour, is a very narrow, tight range, as you can see here, and as you can see here again. If you look at the actual day sessions, you will see a very different picture where, in fact, the initial balances will be more expanded, they'll have more range to them, and they will be key reference points for the market, as you will begin to see. All right, now notice here how this initial balance low of this particular day ended up identifying for us a key level of resistance on the chart for 1, 2, 3 different sessions. And it wasn't until we were able to penetrate through this resistance level that we could take prices higher. And so you see that once we identify these initial balance lines, we need to take a look at them over a period of time, sometimes expand and push them out to the following periods so we can see how the market will react to them. In this case here, it was a level of resistance, but in another case, it could certainly be a point of support. Now, prior IB level respected. So once again, take a look at this level here, which was an initial balance low, an IB low. And if I extended this line all the way out into the future, take a look at what happens when we come back and visit that line. We try to get above it. We're not very successful. Look at what happens the following day. Prices drop. Okay, now notice again down the road when prices come back up for another retest, they're not able to penetrate that level. Hopefully you're beginning to see that these points on the chart, or the reason that price behaves the way it does, is not random or haphazard. It really is responding to these key levels related to the initial balance. Well, what is it about the initial balance that makes it so important? Well, you need to appreciate the fact that what happens in the initial balance is going to dramatically influence developments for the day's trading session and trading activity. And consequently, the participants in the initial balance are usually the heavy hitters, if you will, or smart money, if in fact the market is going to see any significant level of activity or directional momentum. So their move begins with the initial balance typically. And on days where we don't end up seeing much activity, you will find that for most of the day the market will just fluctuate between the initial balance low and the initial balance high. So the initial balance is a critical period and has significant ramifications, and therefore it is used in many different types of trading algorithms. And that gives it another added significance, and that's why we need to pay attention to them, and that's why we will look at a strategy for trading on the basis of these IB levels. So now let's get into our initial balance trading strategies. What would we do? How would we trade these initial balances? Well, one way to help us take a look at the market and what's going on in the market and the initial balances is to actually use a split profile. Now, not often will you hear me sort of trying to employ or implement a strategy using the actual profile chart. I'm usually extracting and taking information from the profile chart, but in this case you could actually trade off of the profile chart. The one thing that you are going to do differently is you are going to split the profile. And what you have before you on this chart is in fact a split profile. So it basically dismantles, if you will, or pushes apart all the different TPOs and just has them in a sequence right next to one another. So let's begin with what we see on this chart. And we have an initial balance for this session. There's the initial balance high. And then notice the A, B period are the first 2 30-minute periods. They make up the first hour. So the low of A gives us our initial balance low, and the high of B gives us our initial balance high. Well, how would we trade this, and what would we do? I mean, how can one really approach this? Well, it's quite easy. Take a look at what happens in the following period, and it's kind of faded here. Period C goes up for another test of the initial balance, and the first strategy is when prices come back for a test of one of the limits, one of the two limits of the initial balance, we want to know what happens, and based on that we will make a trading decision. So in this case, period C comes back for a retest, and period C actually finds resistance. So it comes back down. But the entry isn't there yet. The entry begins when actually period E takes out the low of period D and period B. Now we are confident that in fact we were not able to penetrate the value area, the initial balance high, and now we are going to head for a test of the initial balance low. And take a look at what happens when we get to the low. The low does not hold. We continue on lower, and notice what happens. We come back for another test. It doesn't quite make it, drops, but it makes it on the second go round, but still no dice. We don't get back into the initial balance. This forms a level of resistance, and prices continue lower. So basically, what is our strategy then? Well, our strategy is quite simple. The first aspect of the strategy is test 1. The second aspect of the strategy is test 2, and we get 2 tests, and both of them give us failing scores. Then that's the time to take an entry or to take a short. As soon as these tests fail and the low of the prior test is taken out by the market in terms of price. So in this case, we tested here at B, we failed, couldn't get up above. We tested with C, couldn't get up above it. D didn't quite give us the entry, but period E gave us the entry. Once we dropped below level D, then this would be where we would be short. Now notice it does come back up, but it continues on lower. At minimum, you are looking at the initial balance, the initial balance low as your first target, and certainly our second target would be our initial balance 150%, and the following target after that would be at 200%. Now keep in mind that with a tight or a small IB range, the realization of the first and the second target are quite high. Once we begin to see wide initial balances, as we do say in this case here, the chances that we would get to a 150% or a 200 get reduced significantly. So keep that in mind. All right, so the parameters for our strategy basically are: we are looking for the initial balance high and the initial balance low to get tested. If the initial balance high is being tested, it needs to be tested twice. If 2 tests fail, as soon as we take out the low of the bar that created the second test, then it is time to take a short entry, in this case, since we were testing the high. Now, we're looking for a range extension lower. As we saw here with period E, it drops below 1 tick and we're in. And that is a very basic, very simple strategy to help you trade the initial balance. In this case, of course, we would enter a short trade because we had rejection of an initial balance high. And as we expressed earlier, the targets, we continue to base our targets on the initial balance levels. We identified our first target as the initial balance low, our second target 150%, third target would be 200%. Now, risk management. Where would we in fact put our stop loss? And the answer really is quite self-evident, and this is the beauty and the nice thing about trading the IB levels is once they're tested twice, if you put your stop loss at the initial balance itself, at the level where the initial balance high is, in this case since we're heading short, that is a safe risk management parameter, and you should stay there as you reach your other targets. Of course, you could push your stop lower, make it tighter as the trade progresses, but this is our starting risk management level or point for this short trade. And as we discussed, our targets will be, let me go backtrack here, will be the IB levels below. All right, let's continue on with other examples of this strategy. Now, so far, I have focused our attention on the actual initial balance high and the initial balance low. I have highlighted and pointed out the 150% and the 200% lines, but now I'm going to point out to you that not only do those levels give us potential targets and then continue on to possibly function as points of support or resistance in the market, they too can be used for our IB level test strategy. Now, instead of focusing on the IB initial balance high or the initial balance low, as prices deviate away from the initial balance, all of a sudden we may be testing 150% or we may be testing the 200%. First of all, let me tell you that when prices continue on and get to 200% of an initial balance level, there is always a good probability that they will return back for at least a retest of the 150% level, especially if we have a wide initial balance. So let's take a look at this particular case and see how we would have traded this situation or this price development. Well, we continue to drop lower. We're outside of the initial balance low, and we've come down to the initial balance high. Sorry, the initial balance 150% below the initial balance low. So in this case, prices come back for a test and they don't quite make it, drop back, come back for another test, don't make it, drop down, come back for another test. So we begin to see a consolidation or a rotation develop around the 150% value here. Now, at what point would I really be willing to go long? Now, if you notice here, this is my first actual test right here. It failed. This is my second test, and it failed because look at where we opened period X back here. Now, period Y comes back up and it doesn't take out the high. So really, I am not going to go long until period Z that actually takes out the high of this other failed test that occurred in period W. And if you take that long, and now your target would be the initial balance low down here, you will once you wait several periods, you will make it and you'll be able to arrive at your target and take your profits. Then look at what happens. This was the first, second test. We got two tests here, and now they have both failed. As soon as you see period G in this case break the low of period F, you know we are going to be dropping down, And sure enough, we drop down to the 150% level, which is quickly followed by another drop to the 200% level. Now, one of the nice things about this strategy is identifying the risk management parameters is very easy, because here, when we have two consecutive failed tests, right away we know that we can put our stop loss right at the initial balance low if we are in fact going to take a short. And similarly, if we come back down here and I had 1, 2, and the third one, rejection of these values, takes out the high of this period, and I enter long with a target to the, of course, 150%, then to initial balance low, the target would still be, when I go long from down here, down at the 200% IB level. So the IB levels help us to identify the opportunity, and at the same time they help us to manage our risk, and then in addition to that they also help us to establish a reasonable target. The only thing that can be a little bit tricky at times is the exact entry, and I try to simplify it. I don't like to enter too aggressively, so I wait until there is a range extension after the second test failure. Now, typically you will see a minimum of 2 tests. Sometimes there is a third, but usually it's just 2 tests, and if two consecutive tests fail, then the market probably will continue in the opposite direction, and that's why it makes for a good trade based on these IB levels. All right, let's take a look at one more together here. They're real interesting trades. In this case here, I have a day session, and it is a very narrow initial balance. Now I want to also begin to show you some things that you need to be paying attention to on the chart. Where is this initial balance, the initial balance high and initial balance low, relative to the prior initial balance? And interestingly enough, you will find that in this case here, the initial balance low is significantly lower than the initial balance high. And the initial balance high here is also significantly lower than the prior initial balance high. So both initial balance low and initial balance high are lower from the get-go. Now, even though they are lower, take a look at what happens. We come back up for a test of initial balance high up here with period B. And what happens? We're not able to penetrate. So we come back down and we test initial balance low in period C. Period C continues to drop even further, but never quite makes it to the 150% level. Now, period D comes along, and if you take a look, period D does in fact go in for another retest of the initial balance low. And it ends up closing a little bit higher. And it is higher than period C. So we had 2 tests. In this case, period E comes in for a third test. So what I'm trying to say is, conceivably, you could have been in a long position in period D, and again, you would have used, if you would have used the initial balance low as your stop, in this case, you would have gotten stopped out. So sometimes it may behoove you, again, when the range is so tight or so narrow, the initial balance high and the initial balance low, to use for your stop loss the lower initial balance reference point, meaning the 150% reference point. This is especially true should you choose to use an aggressive entry for whatever reason, and you are taking the entry before the trade actually continually begins to develop or arrives at a point that becomes obvious. If you're doing that, then yes, you need a little bit of a wider stop and using the next IB level, meaning in this case, since we were going for a long, it would be the 150% level. We then would take a long. We wouldn't get stopped out of it because the stop is way down here. And naturally, our target is ultimately the value area high. However, in terms of targets, I will also point out to you that this initial balance low, if I'm trading in this day, is also a reasonable and legitimate target. So if I took some entry from here, I may want to take off some of my profits at this initial balance low right here. This is my next level, perhaps my ultimate target, and prices could continue on higher all the way up. They could go all the way up to here and possibly the initial balance high of the prior day. But notice we get 3 rejections here, K, L, and actually we don't get a rejection of this high level up here, but this is rejected down here as well. And so prices don't continue to drop precipitously, but what they do is we get the settlement period and we close near the high. This is an especially challenging trade because if you notice, period N is our settlement period. Now take a look if, in fact, rejection 1, rejection 2, and then as price drops, I go short in period M. What happens period M? It drops down to the volume point of control for the day and then shoots back up, and N shoots higher. Now, if I didn't want to get it stopped out of this trade, I would have probably put my stop up here at the initial balance high, and that's certainly acceptable, but and I would have kept you in the trade. But notice what's going to happen now. You are actually going to get trapped in the market overnight, and if in fact you were trading with depending on the size of your account and whatnot, but if it could potentially trigger a margin call as well. And that's why it is very, very tricky to try to trade late in the day. This is a period certainly not for beginners, that end settlement period. And take a look at what happens the following day when the morning opens. Here's my initial balance high. Here's my initial balance low, and take a look. Period A spans almost the entire range between the initial balance high and the initial balance low. So here I couldn't do anything because I couldn't short. I only had technically one rejection. But remember, if you take a look at this same level and go back to the prior day, notice this level is very close to the 150% level, and this is what I mean by the importance of the reference of IB lines as reference lines. So you actually had several tests. You had one period K, one period L, another period N, and now period A fails. So you need to keep in mind the continuity between the different sessions and between these levels. And at points where an initial balance high, 150%, and another initial balance high tend to meet or coexist within a small range, immediately recognize that that is a critical area in the market and be attentive to it. Now, if you had traded this day based on what had happened in the prior session, you would have been very comfortable taking a short right here, because this came up for a test, it failed, this came right down, took out the range of period N, and you would have been short here, and this would have been a real nice quick trade for you in the morning with some profit. Again, risk management as usual. If you want to give yourself a buffer, use the IB level above the level that is being tested. If you are confident that you've picked a level that's not going to come back and get revisited, then you can do that with a tighter stop loss. However, my recommendation is to just give yourself a little bit more room. The fluctuations tend to happen, but rarely do we come back and hit a higher level than the one that was tested and failed several times. Targets, the answer is easy. Again, you're going to use, notice here the target would have been the initial balance low. In this case, when we didn't have the initial balance low as of yet, the target would have been from the prior day, the 150% mark. And notice how, in fact, using that IB level from the prior day's session works, and we would have made that target. Now here we had something really interesting begin to take place, and we had kind of an interesting cluster. Let's focus on it and take a look at what's happening in this area. Another potential trade. Remember, the premise of this whole strategy is the idea of when price tests an IB level. Let's take a look at what happens when that IB level is tested, regardless of whether it's an initial balance high, an initial balance low, or if in fact it is 150% of the initial balance, or if it's 200% of the initial balance. So once prices come to test, and we're not going to react based on a single test. Usually we want to look for a minimum of 2 tests, and then what happens? Well, if we get 2 tests and both tests fail at the IB level, then we get a range extension. We take the trade in the direction of where the range extension takes place. Very simple strategy, but very effective. Now, let's take a look here because this looks very congested. The point that I want to make to you is that no profile really trades in a vacuum. Everything is interrelated, and the trading that's going on in this session before you is related to what preceded it. So this level is an important and critical level, and it carries on through. And notice also that in this same zone we have an IB 150% value, which is another important reference. Then we end up with the initial balance low for this trading day in that same zone. Now let's take a look at the tests. One test, then we come back up. So we try to move lower, but we're not able to. So again, we had one test down, didn't work. Second test, third test, fourth test, fifth test, sixth test. Now notice the first time we get a range extension upwards is in period J. Now that's when you could take a long entry. So J takes you up to K, but then that never quite makes it to the IB high. So what do? Well, notice it comes back down for another retest of this IB level. If you put your stop down here at the 150% level, you're okay. You could ride this wave. It may take a little bit of time. As a matter of fact, it will take a little bit of time, but ultimately you're going to make it to your target, which is the IB, the initial balance high up here. Now, you would not have made the target in the same day, but look at what happens the following day. Bam. The A period takes you right up there to the high of that day. All right, the initial balance high up here is in fact the high of the day for this particular session. That does happen every once in a while where we put in the high right at the open. It doesn't happen very often, but it does happen every once in a while. Again, the risk management, a safe point is always the level below the level that is being tested. In this case, since we want to take a long, the level would be below it. If in fact we were taking a short, it would be the level above it. Now notice in this area here we had quite a bit of congestion, and it really had to do with so many reference lines together. Whenever that happens in the market, these are key critical nodes or levels in the market, and you'll see a lot of activity in those areas, as you did right here in this tight zone before prices broke out. Now, from a general analysis point of view as well, once you split the profile like this, and you notice that we ended up closing up here, closing the session up here, and in fact this held as a level of support. After all, take a look at how many times this was tested. It was rigorously tested, and then we were able to hold another level a little bit higher. I should know, or I should say, I should be comfortable in taking a long the following session. Possibly prices would come back for a retest here, but if they don't, I would be comfortable taking a long at any point that we exceed the high that we were at there. Now notice if I took the long here, it took me higher, but then it brought me back lower. And then notice what actually held or provided support to me, an initial balance low. These are very key, very important reference levels in the market. Risk management, the rules are the same. Target and entry. Risk management, you're using the other IB that is above it or below it. For target, you're also using your IB levels. And for entry, we're using the direction of where the range is extended. Let's continue on. All right, let's continue on with another interesting example here. Let's see what happens with this test. But first, let me point out to you the extent or the range of this initial balance. Notice how wide this range is. That is a very wide range. That's typical usually of what we would call a rotational day, where really we end up seeing prices rotate up and down within that range for the entire day. But let's take a look at our test. First test, B period. C period then drops. D period comes back up for the second test. Okay, now E period comes down, and again it tests again, fails. So now we've had 1, 2, 3 failures. F period comes down, takes out the low of E period, the last test that failed. Well, I'm in. So I go in for a short. Where's my target? Down here, the initial balance low. And it does meet my target. As an intermediate target, since we had such a wide range, this would be a reasonable plane as well, or a reasonable price level right here based on the initial balance high of the prior session. They're all interrelated. Nothing in the market is really sort of operating in a vacuum. It is all intertwined, and one thing influences another, and that's why those levels are really key. And the IB trading strategy is quite powerful and useful. Now, we will look at in our next lesson operationalizing it a little bit more, meaning we are going to look at it in the context of a candlestick chart, and I will give you a chart definition that will have the IBs for you on that, and we'll take a look at that, and then we'll begin to also use some technical tools to help us refine our entries. But this is the basic thrust of the strategy. What happens to price when it gets to an IB level and it tests that IB level and at what point do you come in and realize that the two tests have failed and it's time to take a directional trade based on behavior of price vis-a-vis the initial balance parameter, be it an initial balance high, an initial balance low, 150%, or 200%. Keep in mind, again, that quite often some individuals, some traders, if we get to the 200% and price actually arrives at that level, there is such a high probability that prices will drop from that level, they just will short automatically at that level. And their target being the 150% level. That is a fairly high probability trade from here to here. A reversal is not necessary to take place, but you will get a retracement at least to the 150% IB level. That happens very frequently in the market. Here's another trade that we want to take a look at. Test 1, test 2. Range extension to the upside. In as a long at this level. First target conceivably would be here. Prices continue to move higher. My goal or my ambition is for prices to get up to here. Now notice what happens the following day. Prices come back down. They never quite, well, they do drop back for another retest of this level if we extend it out. The level holds and it shoots back up and comes back to the original target that I had wanted to reach up here. Notice right there? Okay. So sometimes these IB trades could be swing trades. They're not necessarily always day trades. Now, you could take it for a day trade, but certainly you are going to get out of it much less than you would if, in fact, you are approaching it as a swing trade where you may want to keep your position for a day or two to realize the maximum potential of the trade. Repeat again, just the same process. So you will see all of the different parameters of the strategy. Risk management based on the IB, target based on the IB, entry based on range extension. And here is the last trade that we are going to look at together. And in this trade, once again, I have an area of congestion. This becomes a strong level of support for me. Tested many times. Once I begin to see that we take out the high of this, I should be willing to take a long, and look at how nicely the long pans out for me. I clear level 1, my initial balance high, I make it all the way up to 150%, hesitate a little bit, but the 150% level gives me support and helps propel me even higher yet to the 200%. At which point you're going to get either a consolidation or a retracement with a minimum trace back to retrace back to the 150% level. Pay attention to the IB levels. It is helpful if you want to practice this strategy. First of all, initially to use the profile chart as I have and to do a split profile. It is much easier to see it with a split profile. And as I mentioned, in our next lesson, I will operationalize the strategy for you and give you I'll give you a chart definition that will have the IBs on a chart, and we will talk about refining the entry a little bit, because here we don't have a lot of flexibility in working with the profile, but the main purpose of it was to show you a broad perspective of how the initial balance reference lines work together and how they're related to one another, and that you need to be looking at what is happening as far as initial balance from one session to the next. And once you track that, that helps you to pinpoint your targets better, and also to identify reference levels of support and resistance. So for example, here on this chart, you can see that we have a very strong area of support here. Take a look here in this area. This has become really a support zone. Every time prices have spent time here, have tried to drop lower, they have moved back up higher. Once again, we move back up higher again. So this is a key level or a key area of support. Keep an eye on those IBs, or the initial balance levels. Begin to practice. I recommend when you look at the profile, completely take off all the other lines, because it gets confusing when you have too many lines on the chart. Just focus on the IB lines. Somebody could only trade using the IB lines, and there are those who use algorithms that strictly go by price in relationship to the different IB lines from one session to the next. And the algorithm looks at the behavior of the price and reacts accordingly. That's how powerful these IB lines could be. All right, with that, I will conclude our lesson 7. And just to re-emphasize, the risk management, the target, the entry, same process, no difference at all for any of the different IBs. We've talked about it again and again. And now we will conclude and open the email for questions and answers. Feel free to send in your questions, and I will address them for you. Best of luck with your trading.